on WPG Talk Radio 104.1.
Hey, thanks very much. Welcome back. Third quarter action begins right here, right now, with Chuck Malamut. This is our final broadcast with Chuck of 2016. So Chuck's going to share with you the market update, year in review, and anything else that he wants to share. In the program that you're about to listen to is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck, happy, merry, belated Christmas. How are you, my good friend?
Harry, happy holidays. Merry Christmas to you and your wonderful family.
Did you have a nice few days?
Harry, nothing better than spending time with family.
It was great.
You disconnect a little bit. As you know, this is a really, tough time of the year for us in the financial services world, is in as much that I know that you sort of chatted about it on the way in as I was listening, and we've talked about it a number of times, and you really need to take a look at what has transpired over the course of the year, because there were several large mutual funds, equity mutual funds, that paid out a fairly substantial capital gain distribution. And if you're not paying attention,
they're going to get hit hard.
You're going to pay a fair amount of taxes come April. So there is still time. Talk to your advisor. If you do it online yourself, take a look at what's happened. Most of the gains have been paid out. If not, go to the respective websites. They'll show you when it will be paid and how much will be paid per share. But for the most part, most have paid out already.
And Chuck, see if you have any problem with this statement coming from a layperson. I think that there's absolutely what people should do: take full advantage of every law that is open and available to you, where you can improve your position, whether it be to make a great contribution to a charity that you've always wanted to support. I want to thank Fred. I saw his email with 1 minute left in the last hour, is making a $1,000 contribution to the Hurley in the Morning charity. That's a year 2016, favorable tax implication event. And so the laws are there. They get imposed upon us. So there's nothing wrong with each and every citizen taking full advantage of the laws that can improve their position.
Harry, you're absolutely right. And talking about charitable giving, most larger charities, in lieu of taking cash contributions, will take stock. Mm-hmm. And oftentimes what clients do is they have an appreciated security in a taxable account. Let's use an example. You've invested $1,000, and today it is now worth $5,000. You want to make a contribution to a charity, so in lieu of writing a check for $5,000, you contact the charity of choice, and you ask for their instructions to see whether or not they will take a security. You then wire that security to them. The date that you make that contribution, you receive a gift letter from the financial institution and or from the charity stating the value of the securities that you transferred to that respective charity, and that will be, in fact, your allowable deduction in the year it happens. So think about it from the perspective, you invest $1,000, it's worth $5,000. You sell it, you have a capital gain of $4,000. In all likelihood, you're going to pay $1,000 in taxes. So now your $5,000 turns into $4,000, and versus making the charitable contribution for the entire $5,000. Certainly, charities, as for the most part, are in need of those dollars. I mean, certainly the charities in this local area need it more so than others. But it's not too late. What you don't want to do is call your advisor on New Year's Eve day, or actually on the 30th, which would be Friday, and say, hey, I want to make a charitable contribution of XYZ shares to the respective charity. I would suggest that if you're serious about doing it, you probably do it now. And if you think it's too late for this year, take a serious look at where we're, as we get into 2017.
Give us, you're doing it now, but continue. Give us sort of insight into the life of the financial advisor. You have a number of clients, different ones have different, situations. As you get to the end of the year, there's a lot to keep up on because you really don't want to get to the first week of January and somebody say, oh, man, I wish I would have known. I could have done that.
So, Harry, every year is different. 2015, there were just a remarkable number of mutual funds that paid out significantly high capital gain distributions to the tune of anywhere from 5 to 20% of net asset value. So that capital gain distribution is basically what we call phantom income.
Taxable event.
Because you will have a tax liability the following April. So this year it wasn't too terribly bad. I think the reportable or capital gain distributions were maybe at best 25% in totality as to what they were last year. But I think this year provides a real significant opportunity because of what's happened in the bond market. As you know, interest rates from the middle of July to where they are now, you moved almost 100 basis points on the 10-year. And then as interest rates move higher, bond prices move lower. So think about it from this perspective. You have capital gains on the equity side, and you want to offset them. So what better way to do it than to find basically what we refer to a swap, where you look at, in this case, a municipal bond. Because munis, unfortunately, because what happened with tax rates allegedly being reduced in the new administration, but I think that one thing we haven't figured out is, you can't just reduce taxes onto itself. There's something on the other side, and that's probably going to be less deductible items in all likelihood.
Sidebar, did you see the one Trump advisor that is forecasting that earnings are going to increase by 20% based on what they're doing?
I did see that, Harry.
I mean, look,
wouldn't
that be amazing?
I mean, if you can just grow GDP by 1%, it's just that in itself is a phenomenal event. But so going back to the municipal bond market got beat up more. Well, actually got beat up much like your Treasury market did. But think about taking a municipal bond, New Jersey State GO as an example, single A. I think it's an A minus A rated position, and then what you do is you find an equivalent piece of paper. Or you sell that, you take your tax loss to offset your gain, and then you take those proceeds and you find a similar instrument. Maturity around the same date, credit quality around the same, about the same kind of quality. You can't swap into the same bond, but instead of being in a Jersey State GO, maybe it's like a New Brunswick general obligation, for instance. I'm just throwing a name out there. So I think there's plenty of opportunity, and it's still not too late to do this. Because if you don't, Harry, you're going to have very, very unhappy listeners come April when they'll be writing checks again to the government for no reason. Now, think about it. All we did here in that transaction is we made a name change. You move from the state of New Jersey to a county of New Jersey. You still get, state and federal income tax relief on the income that you receive because it is a New Jersey state issued bond or bond issued in the state of New Jersey, I should say. But you have to make absolutely certain what you don't want to do is forego, rating. You don't want to forego maturity date. You certainly don't want to forego the coupon or the interest that you're receiving. So there's a lot of moving parts, and if you have a qualified advisor and they know what they're doing. It should be no problem. It should be, sort of business as usual.
We'll continue Chuck's market update in general, 2016 year in review when we continue. For all of your financial planning needs, turn to Chuck Malamut. He is the managing director. He leads his group, the Malamut Group, at the Morgan Stanley's Northfield, New Jersey office. The number to reach Chuck and his team, 609-383-2010, 609-383-2010. We'll be back in just 2 minutes. Chuck, I was thinking about something. If I use the term 30 years, you've been a financial advisor, because I've been on the air now 26 years. You were a financial advisor for several years prior to that. I can't remember if you were a financial advisor when Ronald Reagan was president or if you just started when George H.W. Bush went into office, which I tend to think is probably true.
1986.
So Reagan was the president. From an inauguration standpoint, you now have basically 30-some years since you've been a financial advisor where we have had that period, especially so when you're going from a current president to a new president. And we've had that phenomenon happen all these times since you've been a financial advisor, from Reagan to George H.W. Bush, from George H.W. Bush to Bill Clinton, from Bill Clinton to George W. Bush. And all these were two-termers except for George H.W. Bush. Barack Obama, 2 terms, and now going to Donald Trump. Has there ever been in your 30 – you know where I'm going with this. It's not political.
No, I know exactly where you're going.
I know. You know me. Yeah, we're brothers, man. But what I'm getting at is I know the answer to this as a layperson. I know you know the answer. Has there ever been a period of growth in our markets between first Tuesday, November, and January 20th of the following year, the likes of which we have seen?
No, Harry, this has been obviously unprecedented. It was very, very interesting that you saw very, very quickly after the market had made that initial down move and then recovered, early that morning and into the day and the following days thereafter. But ever since what has happened, the market at this point in time is just sort of churning to the extent where very, very little movement at the end of during the day as we're digesting these gains. So the last couple weeks, I guess the best way to put it, have been muted at best. I mean, the S&P and the Dow last week, small uptick in advance of the holidays. We were up 0.3% for the S&P. The Nasdaq was up 0.5%. Treasuries on the flip side, as you talk about fixed income, spent last week again in a very, very narrow range. The 10-year had a modest uptick after 6 consecutive weeks of losses. You think about this, from July, when the 10-year was in that 140, 150 range, and now it got to a 260, and then has since backed off. Right now it's about 255 or so. But that's you saw a tremendous flow of funds out of fixed income into equities as a result of potentially what's going to happen, with our economy. Now, the one thing that you need to understand and really take a close look at is that you might see some outflows as we get through this week and the next couple of weeks out of U.S. domestic equities, and a rather significant inflow into bonds. The projection is $32 billion out of equities and $20 billion into bonds, and that's because besides buying bonds, pensions, might also be buying some emerging market equities that have gotten beaten up a little bit. Pensions need to rebalance their holdings after the strong performance that we had with U.S. equities since the election and the weak performance in bonds. So don't be at all surprised if the market, goes through this ongoing, churn, where you're not going much of anywhere on a day-to-day basis. And you think about what's going to happen. So you have January 20. You have corporate earnings that will begin. You'll see those, Harry, around January 7, 8, 9, 10, somewhere in that range. So you're still in that quiet period right now. And then on top of that, you are in the midst of the holiday season, and virtually it's very, very hard to get almost anyone to focus.
What do you think, Chuck, that since November 9th to the present, the markets are greater in number than they had been by $1.6 trillion? What do you think that means short term for the fourth quarter of 2016? And what do you think that means going forward?
Well, Harry, look, the S&P, the Dow Jones, and the NASDAQ, we're all up fairly significantly from the date of the election. And please don't quote me, I'm looking for the actual statistics, but if my memory serves me correctly, the the Dow was up the greatest, followed by the S&P. The Dow up maybe 8% and change, S&P mid fives, and the NASDAQ like 2.5 to 3. So that created a lot of confidence, and the expectation is that you're going to see really, really strong Christmas sales. Not so much in the brick and mortar, but more on online. Mm-hmm. And I mean, I know that Donald Trump took credit for that the other day with one of his tweets, but I think that most of us, if you took a poll, most Americans today are feeling a lot better than they were, say, 6-8 months, a year ago.
And they did take a poll, and I have it right here in my briefcase. And the poll is saying exactly what you said. The American people, see if I can find it. (2017). This is people looking into 2017, and the numbers are fantastic. There's something like a 15-point improvement from last year's poll at exactly the same time. Last year it was something like in the 30s. It's 55% right now that believe that things will be better in the coming year than they were in the year that's just concluded. So I think that does matter. I read a very interesting piece. I try to do a little bit of homework before Chuck's program just so that we can have a intellectual conversation together and try to impart all this important information that Chuck brings to you each and every Tuesday morning in the 8 o'clock hour. And I read a piece this morning just a little while ago on it's time to protect your portfolio. How do people best, in your estimation? I know I say it every day, even when you're not here. Your perfected concept of total asset management with the proper asset allocation positions one for the greatest, opportunity of consistent success. But in general terms, however you want to describe it, I won't say general terms. However you want to describe it, Chuck, how should people listening right now protect their portfolio?
Well, Harry, there's always a discussion about buying the VIX in an upward movement, which is basically the volatility index as it's referred to, and a VIX works just the opposite of equities. As equities move higher, the VIX moves lower, and when equities move lower, the VIX moves higher. That's a possibility. But it's like insurance, and it costs money to do that. And are you willing to cut into your return by paying for that insurance? I think what's really important here, and where a lot of people lose sight, is the fact that in a rising equity market, everybody wants to get on the left side of the boat. And let's say, for instance, the S&P's up 10%, for instance, but I think more realistically, let me give you an exact number. So, Harry, S&P up 12.8% year to date. So investors get very, very disappointed when they have a balanced account and they have, let's say, they have a 50-50 equity fixed income portfolio, and this year fixed income went virtually nowhere. So let's say your return is 6.5%, 7%, 8%, and oftentimes clients aren't satisfied with that because they want to capture all the upside. But in the interim, when things go the wrong way, they want to be on the right side of the boat, and they want to be protected if the equity markets go down 15 20%. So I think what's really important, Harry, you're not going to be able to time the market. There's all kinds of surveys that have been done. When you look at the average returns, it's not so 92% of returns that you receive are not from not timing the market, but spending time in the market. And I think what's really, really critical is that you pull out your financial plan. You look at your retirement analysis, you look at your college analysis, and you want to see if you're on track. And if the accounts were set up not to try to hit home runs, but hit singles and doubles, and get to your retirement goals, what's wrong with that 6, 7, 8% return?
Sweet. Nothing's wrong with it. He's Chuck Malamut. I'm Hurley in the Morning. Remember, for all of your financial planning needs, So it's not too late to give Chuck a call now. 609-383-2010. 609-383-2010. The Malamut Group, led by Chuck Malamut, who is the managing director of his office, his team. The Malamut Group, they're at Morgan Stanley's Northfield, New Jersey office, 609-383-2010 for all of your financial planning needs. We'll be back in a couple more minutes, more with Chuck Malamut straight ahead. Welcome back. Yours truly, Hurley in the Morning with Chuck Malamut, the official financial advisor to the Hurley in the Morning program. We're in our 26th year together, and as you know, Chuck's been doing what he has been doing since 1986, so he predates this program by about 5-6 years. But Chuck has been with us since day one, literally was the first advertiser on the Hurley in the Morning program. For all of your financial planning needs, turn to Chuck and the Malamut Group at 609-383-2010. Chuck, Santa Claus rally.
Harry, yeah, good point. I mean, there's been Did you? Do your listeners know what you're wearing today?
I came very festive. I did announce, Bruce, you were not listening at the time.
No,
but I do know
wasn't.
that you did catch part of the program in the 6 o'clock hour. I did note that I'm in a very festive red mock turtleneck with a very handsome gray. It's a Dockers sweater vest.
I kind of would have really liked to see you like in a lime green vest. I think that would really.
I do have a green one.
I think maybe next week you should wear that.
And listen, I could be in here in my pajamas because me and Mike Rubel, we're the only two people here, I think. Go ahead.
All right. So, Harry, you know, at this time of year, there's always a discussion about the Santa Claus rally, but I don't think most people really understand what the Santa Claus rally represents.
Donald Trump. No. Just go ahead. Go ahead.
So, Harry, if you go back and look at the Stock Traders Almanac, the Santa Claus rally falls on a 7-day period spanning the last 5 trading days of the old year and the first 2 trading days of the after New Year. So that would put us between December 23rd and January 4th of next year. So over that time period, on average, the S&P sees a gain of about 1.4% in that 7-day period. If the market fails to rally, it could be sort of a precursor to a potential bear market.
Time out. Will the markets? I don't even know how this is going to go, but you know where I'm going to say.
Yeah,
will they take into consideration that we had the most unprecedented growth from November 9th prior to this? That'll be ignored?
No, Harry. I'm not sure if it's going to be ignored or not.
Can't
but
be ignored.
I'm just merely giving you,
but you got
by historical standards.
The Trump bump is without precedent.
Oh, for sure. So
we might not see that because it may have already happened.
If the Santa Claus rally holds true to form, what happens is in a down over that 7-day period, if the market is down, it could be a precursor to a bear market or potentially a bigger sell-off.
I can't believe we're talking about that after what we've experienced.
Now, if you go look at last year, as an example, there was no rally. The S&P fell 5.1% in January before bottoming in February. So, the psychology that's in place seems to be setting up for a little bit of an upward movement. I'm not quite certain how you're going to get, that big, huge move because, as you just said, the market is digesting the gains that were put in place from the beginning of November. So the question is, and I'm surprised, Harry, I'm very, very disappointed in you, actually. It's 8:37.
I know.
And you haven't asked the question.
Go ahead.
When are we getting to 20,000? I thought for
well,
sure.
The reason is because it's so tantalizing. As we begin the program this morning, we are fixed at 19,933.81. So in the last trading Dow, the Dow was up 14.93. It's been so tantalizingly close. I
think at one point in time we got 14, 15 points away, and then. But look, and
it pulled back a little.
This is going to be a tough week because there has been the volume traditionally dries up. Mm-hmm. There's just, as you noted here, there's it's very, very quiet here. It's very quiet driving in. A lot of people are not focused on their financial affairs, and a lot of institutions or hedge funds, private equity funds are closed.
So those 65 points are going to be tough to come by this
week.
Well,
and look, there's not most of the news flow comes today, and as you get to the end of the week, there's no news to report. So it's still not much of a push to get there. If you see at the end of the day a fair amount of funds flowing into the buy side of the market, you could very well get there. I don't think it's. I mean, I guess all of us would like to see it before year end. I don't think it's impossible, but I think what happened was, every day for all of last week, or 20,000 Dow, 20,000 Dow. I mean, I think the media did a remarkable job
hyping.
Yeah, and basically, getting everybody exhausted from the activity.
It was a Dow 20,000 watch.
Exactly.
Not by the minute, by the second.
So we're close. So, Harry, it's amazing. We're kind of up against the clock here. One of the things we chatted about last week is what in fact was accomplished during the year 2016. 10 basic thought processes. We talked about GDP. It remained below 3%. Nominal GDP was below 5% for unprecedented 10 years in a row. So that was a prediction. It was correct. U.S. Treasury rates rise for a second year, but high yield spreads fall. That was correct as well. As we just talked about, Treasury yields moved 100 basis points off of their lows from July. Who would ever thought a year ago the Fed makes their 25 basis points move? Everybody was expecting Treasuries to move higher. They moved lower. Then ultimately they moved higher towards the end of the year. S&P earnings make limited headway as consumer spending advances are partially offset by oil, dollar, and wages. That was correct as well. For the first time in almost 30 years, this prediction was questionable, probably wrong. U.S. equities look at a single-digit percentage change for the second year in a row. Well, that didn't happen.
No, it didn't happen.
And that's all good.
It is good. Hey, Chuck, I want to double down on something you brought up. Not only have we been lower than 5% GDP for the past 10 years, we've been under 3% for the past 8 years. Both are unprecedented, have never occurred in American history. If we get to, and you and I both sort of suspect this, there is a chance, I even think there's sort of a good chance, that fourth quarter 2016, we could see 3% or slightly greater than 3% GDP. Who gets credit for the fourth quarter? Who gets credit for it? The outgoing president or the incoming president?
I know that you chatted earlier. I'm smiling if you can't tell.
I can tell.
You were chatting earlier today about the outgoing president and the fact that I think that if he was he would have won if it was a third term.
He says so.
He in an interview was absolutely convinced. So, but a lot of this, Harry, was actually earnings were actually trending higher, during Q3. So, I think you have to give credit partially to the outgoing administration.
I give him partial credit, but
you
have to credit
the incoming administration.
Trump bump.
Oh, absolutely. I think that I think a lot of what is happening was sort of in place already, and the market was looking for that stimulus, for that reason to go out and and move money off of fixed income into equities.
Do the same geniuses that I disagreed with, do the same geniuses that wanted Hillary to win because, after all, our markets don't like uncertainty and really wanted that to happen, do they now agree that we've had a bump that we never would have ever seen if the election had gone the other way?
It's interesting that you've had very, very few people make that statement.
I make it because had Hillary won, there's no way there would be the enthusiasm, and there's no way that markets would have moved the way that they did.
Harry, I agree with you, and I think it caught everyone off guard. And you think about,
except your boy with two thumbs.
But if you think about the fact that again, if you look at a long-term trend of equities, this again is another event that drives the market, and I think this is not a sprint. This is a marathon. And Harry, we've been talking. I mean, we've been running this marathon with you for 26 years,
yes.
And I think the message that we've delivered has been very, very consistent from day one to where we are now.
True.
If something works, there's really no reason to change it. We're not going to be right all the time. There's no doubt about it.
2-minute drill. What's the story of 2016? Because nothing major is going to happen this week. We could be up a little bit. We could be down a little bit from the levels that we're at now. But nothing phenomenal, I don't think, is going to happen in the next week. And we don't even have a week. We have a few days. What's the story? Because I think you can tell it now. What's the story of 2016?
So, Harry, assuming no major changes, S&P, up over, 12%. The Russell 2000, your small caps, up almost in excess of 20%.
How long ago did the S&P being in double digits seem like fantasy?
I'd say less than 3 months ago.
Yeah.
If you go back and look,
yeah.
As we were in September, we were just sort of churning, so to speak, moving along at a sort of a snail's pace. And, obviously, this country is going to go through a very, very dramatic change, I think, and hopefully we will regain that enthusiasm that we lost. You kind of feel like a lot of Americans for years, actually for 8 years or so, Harry, were thinking or feeling the fact that they had sort of somebody's foot on your throat.
Yep, felt a little helpless.
And you couldn't really go much of anywhere. So now, and granted, look, not every president's going to get it perfect. I mean, Trump will do a lot of good things. Trump will make some mistakes.
No doubt.
But the bottom line at the end of the day, I think if you kind of fast forward this several years, I think a lot of us will be feeling a lot better about our country. I think we will feel a lot safer, domestically and internationally. And I think, financially speaking, I think, a lot of our clients and a lot of your listeners, Harry, will be in a better place.
I mean, historically,
than they were, say, 4 years ago.
Historically, if the government is focusing on protecting the homeland, especially, in the age of heightened there was always terrorism, but heightened terrorism, 2001 to the present and beyond. If we're focusing on that, strengthening the military, improving our relationships, these are geopolitical events, as you would call them, Chuck, improving our relationship with our friends, having respect again in our adversaries, respecting us more than they have. If we have an environment where the president is leading an effort to lower taxes for corporations, for citizens, lowering taxes, lowering tax rates, I would think making it possible for a lot of money, trillions, maybe to come back to America that's been parked outside of the country. If all these things get done, and I believe they're the priorities of the new administration, we should have a really good time of growth ahead.
Harry, absolutely. Now, there will be some bumps in the road that we're going to need to overcome. But I think that 2017, and it's a little early, we'll make we didn't finish our thoughts for 16. I think there's a few out there that we'll get into next week, and maybe where we're going in 17. But you did. I will close on the fact that we talked about geopolitical risks and terrorism last year, and one of the things that we chatted about is the fact that we really didn't think that it would bother investors and would have very, very little impact. And as it turns out, the geopolitical risks as we know them. Let's talk about Brexit for a minute. Let's talk about everything that's going on in the Middle East. They became a lot more complex with terrorism and cyber attacks. They became more common than anything else. So, however, for the most part, markets really didn't react to that, Harry. Very, very limited downside risk. I mean, you might have had a sell-off on a short-term basis, but the markets had a tendency to move back up in a positive direction.
Great stuff. Again, for all of your financial planning needs, turn to Chuck Malamut, 609-383-2010, the program you just listened to, presented by Chuck Malamut Weekly, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this program, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck, Happy New Year to you, Pam, the entire family. We will reconvene on Tuesday, January 3rd in the brand new year.
Same to you, Harry. Happy New Year. Stay safe.
My man, you do the same. He's Chuck Malamut. We'll be back in just a couple of minutes. We're brought to you in part by Congress Hall